I have two quick things I want to say. One is the biggest mistake I see entrepreneurs make when they're raising money is that they're too focused on this valuation and trying to get the most out of this particular transaction. And they don't realize that the process of raising money and growing a business is one that has multiple transactions and you're building relationships, kind of like Matt said. And so, sure, you could maximize. You may have a two people in a garage business and you may be able to get some crazy $15 million pre-money valuation and raise a bunch of money. But what corner have you just painted yourself into? Because your next raise, because you're going to run out of money, is going to be expected to be an up round from that. If it's not, you're kind of tainted goods. And if you set that bar too high, you've put yourself in a really difficult position. So don't think about it as maximizing this transaction. Think about the journey you are embarking on and what the next step and the next step. It's like playing chess. Don't just look at this move. Look at your next move and your move after that. The second thing is on the comment about valuation in the public markets, and I think it was Fred Wilson 2 days ago that said something to the tune of, markets go up and down and are trendy, but good businesses never go out of style. And that's true, and that's one of the strengths that we have here in Chicago. So most of the businesses that have done well here in Chicago are businesses that have real revenue models, real transactions. I refer to it as enabling commerce. If you think about a lot of the big, Grubhub made money on every transaction. Groupon, love it or hate it, made money on every transaction, right? All of these guys, even going all the way back,
Spot Hero.
Spot Hero's making money on every transaction. One of ours, Sure Payroll, Sitter City, all these, they're all go back all the way to Orbitz, right? And those are real businesses where the valuations are not based on some mythical thing in a market, but they're based on actual cash flows and business model metrics that matter. And if you're building a real business that has real revenue, you're not going to be as subjected to these wild fluctuations in public markets.
And a great vehicle, by the way, for angel rounds to use is a convertible note. Because you're going to try and guess how a VC is going to think about pricing, but if you're wrong and you price it too high, your investors are going to get crammed down. So just say, you know what, I'm not that smart. I'm going to do a convertible note, and it converts in when it gets priced at a discount. And the second is, by the way, we may talk about Armageddon, unless it's a sophisticated guy.
Not everybody loves convertible notes.
I was going to say no caps too, right, Matt? Jeez.
I didn't say that. And then the other thing is you'll hear a lot about Armageddon and dead unicorns and stuff like this. Literally, if you go back to like 1850, and we've done that, literally the majority of the Fortune 500 companies and the best companies in tech today all got started in downdrafts. And so, if anything, if you do what Troy says, which is focus on your fundamentals, raise your capital, make certain you have runway, don't burn a lot of money, downdrafts are the best thing that can happen because all the competition gets wiped out. That's why you're killing it right now.
Yep. And I'll comment on this valuation question too, because I spend a lot of time thinking about late stage and early stage. At the late stage, valuations do seem high. At the same time, there are a lot of real businesses here, and multiples are high across the board. If you look at real assets, a lot of them have actually ticked up to a point that's even more uncomfortable than public equity valuations, and a lot of that's cost of capital is really low. So there's a lot of stuff there that has to get worked out. But I look at a lot of those late stage deals, and the valuation is high, but they're real businesses in a lot of instances. On the early stage side, I'm even more worried about valuation, because what Troy said and what Matt's been saying is absolutely right. This is really the first inning. So, optimizing valuation in a seed round may feel good, but it's probably not your last round. And you have to be very specific about what that capital gets you to and what metrics you're going to have to raise your next round. And sometimes these high valuation seed rounds are the easiest rounds you'll raise, and it's a bunch of people, but then you show up a year later or 9 months later, and it's really tough to get your A done. And I'm seeing this a lot, right? And then people complain about the ecosystem or what have you, but it's really not the ecosystem. And there's plenty of capital. It's really that the company has raised a high-priced round and then hasn't proven much of anything. So I think the real valuation fear or danger I have or see is really high-priced seed and high-priced early rounds, because often there isn't much of a business there at all, and then you're left, nowhere.